Hi, welcome back to another edition of Lipper's Fund Flows Insight Report. My name is Tom Roseen. Thanks for joining me today. I'll be reporting estimated net flows, which basically measures the purchases and redemptions of investors into mutual funds and ETFs. Now, in the past, I've actually just given kind of consolidated numbers just for mutual funds, but I'm going to change this up for, going forward, and I'm going to be reporting flows into both, at the top part, in both flows into both conventional funds and ETFs. Now, I will break down, as I have in all the other episodes that I've ever released, I'll break them down into conventional fund flows and ETF fund flows as well, so we'll get that detail. For the week ended Wednesday, October 21st, 2020, we saw outflows of about $7.6 billion from the fund business. Again, that's including both ETFs and mutual funds or conventional mutual funds. This is the 11th consecutive week that we've seen outflows from the group, and I think people aren't going to be too surprised by it because, basically we saw that there was a great amount of uncertainty out there in the markets. We've seen an increase in COVID-19 related cases. In fact, some states are setting new records as far as daily records go. We saw that there's been a continuous impasse on Capitol Hill for a COVID relief second round of a stimulus package. And most people, I think, anticipated that it would probably happen after the election. Neither party wants to be able to give in and give, if you will, any of the cookie jar away, before the elections. And I think they'll move into it pretty quickly after the elections. A lot of people are saying we probably won't see anything until January. And additionally, we have the problem with the elections coming up, and I won't say it's a problem, but there's a lot of uncertainty surrounding who's going to be doing what and what's going to be happening. And so I think people are willing to put on the brakes. Now, that said, we saw investors actually be net redeemers of money market funds, which we'll talk about here later, but really fixed income was the main attractor of investors' assets during the week. And we saw that NASDAQ and even the Dow and basically all the broad-based indices here in the U.S. saw negative returns. The NASDAQ suffered about a 2.41% decline during the fund flows week, and that's a Wednesday to Wednesday period, or if you want to call it Thursday morning to Wednesday afternoon period. Well, let's see how this news actually broke out as far as flows go into the originally it's going to be conventional funds fund flow arena. So basically, if we take a look at it, and again, now this is basically a consolidation now of both groups still. So I'm still on that same kind of charge. Basically, we saw equity funds hand back about $5.7 billion. Taxable bond funds taking about 6.8. We saw municipal bond funds only taking about a little over $300 million, and then we saw that money market funds were the big pariah, as it has been the case for quite so many weeks now. $9.3 billion this week. Well, let's go ahead now and turn our attention back toward, again, that breakout I was talking about. Let's take a look at our first breakout and take a look at equity mutual funds and see how flows occurred in this arena. Basically, what we saw was that for the first week in 4, we did have negative returns, this time to the tune of 1.19%, so there was a decline. Nothing big, but again, enough people to show that people are nervous. For the week, we saw about $6 billion in outflow. It's the 26th consecutive week they've seen net redemptions from this group. Domestic equity funds handed back about $4.7 billion. It's the 19th consecutive week they've suffered net outflows, and they had a return of minus 1.40% on a market basis. It's the first week in 4 also that they saw negative returns. Now, non-domestic funds only shed about 0.73% of their last week's NAV. So again, returns were only down about 0.73%. But today they still lost about $1.3 billion, and it was the 9th consecutive week they have seen outflows. Now, if we take a kind of a play-by-play, we saw that on the domestic side, large cap funds lost about $4 billion. But equity income funds, investors turned their attention back towards yield-producing securities, and we saw about $235 million of net new money come into that group. Now, on the global or international side, non-domestic side, as I've titled it before, international equity funds handed back about $976 million, and global equity funds handed back a little over $309 million. So it really kind of is a continuing story. We didn't see anything drastic on this side of the ledger, so to speak, but we are seeing some concern out there, and there has been concern. I mean, 26 consecutive weeks of outflow is a pretty amazing number as far as those outflows go out of equity funds as a whole. So let's go ahead and take a look at the equity ETF side of the arena and see what happened with this group. Basically, for the second consecutive week, we did see inflows, but this time to the only tune of $304 million, very low for the ETF universe. SPY, which is Spider S&P 500 ETF, basically took in $5.2 billion. iShares, the ESG Aware MSCI Emerging Market ETF. Again, people are more interested in these ESG type of funds. Took in about $563 million. But on the bottom side, we see Invesco QQ Trust 1 lose about $2.1 billion, and the iShares Russell 2000 ETF hand back about $1.1 $1 billion. So we had some consistency here. You know, both the conventional fund investors and ETF investors were more risk averse. While the ETF universe did see some positive flows, again, $303 or $304 million is a very small amount. So investors are basically, I won't say slamming on the brakes, but certainly taking a pause, not doing a lot of buying, not doing a lot of selling, but basically sitting back and kind of waiting to see what's happening over the next week or two. Well, let's turn our attention now to the fixed income side of the universe and see what happened for that group. Basically, for the third consecutive week, they've taken in net new money on the conventional fund side. So for conventional fixed income funds, basically saw about $5.1 billion net new money coming to that group. It's the first week in four that they've actually seen negative returns, though, down 0.40%. So again, we're talking not big changes. We've been seeing some very large moves in the markets as of late, and this wasn't a big move. And certainly people are still playing, if you will, kind of the safety game. Corporate investment grade debt funds took in about $5.3 billion. Government treasury and mortgage funds took in about $434 million. On the downside, we saw flexible portfolios funds hand back about $1.5 billion, and corporate high quality. People, again, are trying to seek yield here, so corporate high quality funds basically lost some money, but only to the tune of about $28 million this week, so not a lot to write home about there. Now, there is some convergence now in thought processes. Again, I think I told you at the top of this segment that people were embracing fixed income. So it didn't matter whether you're a conventional investor or an authorized participant. Basically, those guys that buy and sell, and I should say create and destroy shares for ETFs, all were on the side of actually putting money to work into fixed income funds. Let's go ahead and take a look at that group and see on a breakout basically what happened to them. We basically saw, this is taxable bond funds. Let me move on to the next one. I apologize. Move on to that. Basically what we saw was that for ETFs that there was about a $1.7 billion net inflow. It's the fourth consecutive week they've seen that net new money come to that group. And the big winner, if you will, on this side of the ledger was iShares 10+ year investment grade corporate bond fund. Took in about $580 million. Following that was the iShares 20 to 10 year Treasury bond ETF. That took in about $358 million. And then we see the iShares 5 to 10 year investment grade. So kind of, people getting rid of the, if you will, the shorter end. And kind of unusual if you're thinking there's some, maybe some things coming at us that might be scary. But anyways, iShares 5 to 10 year investment grade corporate bond fund lost about $776 million, while Spider's Bloomberg Barclays high yield bond fund had it back, and we might expect that, $632 million for this fund flows week. Well, that makes us now move on to the next group, and that would be muni bond funds. And muni bond funds actually saw some pretty good numbers this week. There's nothing to write home about. Again, I keep using that term over and over, a little bit cliche there, but $724 million in net new money came into that group in this third consecutive week that they've actually taken in net new money. Now, this time they did have a little loss. It's the second week in three that they've actually seen losses. Basically, they handed back 0.06%. Now, the big winner, though, when we talk about flows, was basically short municipal debt funds. Took in about $424 million, followed by short intermediate municipal debt funds, which took in about 128. There was a couple of small negatives on the single state side, but nothing really to talk about there. Now, I don't really provide any slides on the municipal ETF, municipal bond ETF side of the arena. It's a very small group still. We'll probably start adding those, though. They're getting to be more commonplace. We're seeing a lot more flows coming in and out of this group. So this week, though, we saw an outflow of about $117 million, and it's the first week in three that they've actually seen net outflows out of the municipal bond fund group. Well, that brings us to the prior of the groups. We've been talking about it for quite some time. So while I said people are being conservative, but they're not buying and they're not necessarily selling on the equity side. I mean, we saw some outflows, obviously, on the equity side. And even on the fixed income side, we kind of saw kind of low numbers coming in, 5.1 billion and the like, and 1.7 for ETFs. But we're seeing people put money back to work in the fixed income side, but not on money markets. So people are finally taking their foot off the brake, basically, and putting money market funds back to work. And so I think that's a good sign, and I think they're waiting to see again what the market's going to do. But anyways, as we take a look at the money market fund group, it tells a little bit of a story of what's going on. Money markets funds for the 13th consecutive week suffered net outflows, this time to the tune of $9.3 billion. Taxable money market funds, though, basically saw the largest net redemptions, $8.1 billion in outflows there. And how that broke out is institutional investors. Again, this is usually our 401k and the like, but it can be, truly institutional investors as well. Basically handing back about doing net redemptions of $12.9 billion. So those folks are the ones putting money back to work. We're seeing that happen in ETFs and the like. On the retail side, though, investors are still a little bit spooked on what's going on. And again, I think they're willing to sit back and wait till all the dust settles before they jump back in the market. They put money back to work in the money market funds, injecting about $4.8 billion. Now, on the tax-exempt money markets side, we saw $1.2 billion of net redemptions, which tells us that people are putting, and we just said that, people are putting money back to work in municipal bond fund arenas as well. So that basically brings me to the end of the conversation that we're having on fund flows this week. Basically, we're going to keep an eye, though, on the brethren and sisters, our brothers and sisters over in the proprietary research group from Refinitiv. They're actually reporting the earnings season statistics, and they're finding that of the earnings season, for the earnings season so far of the S&P 500 reporters, about 135 have reported thus far, and 83.7 beat their estimates. So this has been a pretty good game, if you will, as far as people, maybe being set up to make a run here after some of this volatility is done after we get into the elections. But 83.7 beat their earnings estimates. But really, all the concern is going to be on two major things: rising coronavirus right now, and that's been a really big issue, and then obviously the upcoming elections. And both of these events have people back on their heels a bit, and we'll have to see again how the markets play out. Let's see how earnings season continues on. What's going to happen in 2.5 weeks when the election comes in? I think those are going to be tellers, and of course, people are going to keep an eye on this winter commingling of both the pandemic of COVID-19 and the flu season, and see if we're going to have any more closures. Well, if I didn't do a deep enough dive for you, you can go to our site at www.lipperusfundflows.com, or you can join us next week when one of our analysts will talk about the fund flows trends for that week. Thanks for joining me. My name is Tom Roseen, wishing you the best in your wealth planning and creation.